Welcome to The Explainer. Today, we're diving into a really big shift in business taxation. We're talking about the new rules for what's called a slump sale, all under the new Section 77 of the Income Tax Act 2025. If you're ever involved in buying or selling business units, then this is something you absolutely have to get your head around.
So let's just frame the core question here. Imagine you're selling off an entire business unit as a whole package. How exactly is the profit on that sale taxed under the new 2025 Act? Well, let me tell you, the answer has changed, and the changes are pretty significant.
So, to get to the bottom of this, here's the plan. We'll quickly cover what a slump sale actually is, break down the new Section 77, run through a calculation, talk about the required paperwork, and then sum it all up.
All right, first things first. Before we even think about touching the numbers, we've got to be crystal clear on the definition. So what exactly is a slump sale in the eyes of the law? The Act itself gives us a very specific definition. The easiest way to think about it is like this. You're selling a whole business unit as is, lock, stock, and barrel for one single price. The really crucial part here is that you're not putting a price tag on every single asset and liability in the deal. It's one price for the whole shebang. Okay, now we get to the real heart of the matter. For those of you who've been working with the old Income Tax Act of 1961, you'll know about Section 50B. While the new Section 77, it changes things fundamentally. And this table really lays out the biggest shift. See, under the old law, the sale price was just, whatever you and the buyer agreed on. Simple, right? But now, the new act brings in something called a deeming provision. This means the tax department can ignore your deal price and instead use a calculated fair market value. And if their number is higher, that's the one that counts. Oh, and you'll also notice the compliance form has changed too, from the old 3CEA to the new Form 28. So this is the single most important thing to take away. The price you write in your sale agreement, it might not be the final price for tax purposes. The authorities are going to calculate this fair market value, and they'll take the higher of the two, your price or their calculated value. That's a huge change. And look, this isn't just some vague concept. The government has laid out the exact methodology. If you look at the new income tax rules of 2026, specifically Rule 53, you'll find the precise formulas. There's really no guesswork involved here. Okay, so the first method, let's call it FMV1, is basically an asset-based approach. It's all about figuring out the fair market value of the net assets you're handing over. You do this by adding up the value of different types of assets, using book value for some things, stamp duty value for property, and then you just subtract the liabilities. Then there's the second method, FMV2, which kind of flips the coin and looks at it from the other side. It asks, what did you get in return? So it adds up all the cash you received, plus the fair market value of anything else you got, like maybe shares or another property as part of the deal. Okay, so that's the sales side of the equation. But what about the cost side? How do you calculate your cost? Well, the rule here is actually quite straightforward. Your cost of acquisition is simply the net worth of the business unit. That's just the book value of its assets minus its liabilities. And one more really important thing, you don't get any indexation benefit on this. None. All right, so that's all the theory. But theory is one thing, right? Let's actually put these rules to the test with a practical example so we can see how these numbers really behave in the real world. So let's set up a scenario. We've got a business unit with total assets worth 70 lakh rupees and liabilities of 15 lakh. Now it's sold for a single price of 80 lakh. But here's the catch. After we run the numbers through that new formula in Rule 53, the calculated fair market value, or FMV1, actually comes out to 90 lakh rupees. First up, we need our cost of acquisition. Remember, that's just the net worth. So we take the total assets of 70 lakh, subtract the liabilities of 15 lakh, and that gives us a cost of 55 lakh rupees. Simple enough.
Okay, now for the sale consideration. This is where that new rule kicks in. We have to compare the actual sale price, which was 80 lakh, with the calculated FMV, which was 90 lakh. The law says we must take the higher amount. So for tax purposes, our sale price is now deemed to be 90 lakh rupees.
And finally, let's figure out the capital gain. We take our deemed sale price of 90 lakh and subtract our cost of 55 lakh. That leaves us with a taxable capital gain of 35 lakh rupees. Now think about that for a second. If we had used the actual deal price of 80 lakh, our gain would have been only 25 lakh. That's a 10 lakh difference in taxable income, all because of this new rule. So getting the calculation right is obviously super important. But that's only half the story. The new act also brings in some very specific compliance steps that you just can't ignore.
Section 77, subsection 4 is black and white on this. It says that for every single slump sale, you need to get a report from an accountant, and this report has to be filed using the new Form 28.
So what's this form all about? Well, it's basically a certificate from a chartered accountant saying, yes, the net worth has been calculated correctly according to the rules. The seller is responsible for filing it, and it has to be done on or before the due date for the main income tax return. And let me be clear, is it mandatory? Yes, 100%.
Wow, okay, we've gone through a lot of technical details, so let's just pause for a moment and boil it all down to the absolute key points you need to remember. All right, here are the main takeaways. First, a slump sale is selling a whole unit for one price. Second, and this is the game changer, the sale value for tax is the higher of your deal price or the calculated fair market value. Third, your cost is the net worth, plain and simple, no indexation. Fourth, that accountant's report in Form 28 is non-negotiable. And finally, don't forget the basics. You still need to check if the asset was held for more than 36 months to figure out if it's a long-term or short-term gain.
So, we'll leave you with a final thought to ponder. Looking ahead at any M&A deals you might be involved in, are you really thinking about how to structure them? It's now absolutely critical to build your valuations and your documents around these new FMV rules from the get-go. Otherwise, you could be in for a very nasty tax surprise. And that wraps up our deep dive into the new slump sale rules under Section 77. I really hope you found this breakdown helpful.
As always, please take a moment to review our standard disclaimer.